payments, meaning his bank account balance would fluctuate and often drop to zero, which made it difficult for him to pay his own suppliers. So he went to his bank, the Royal Bank of Scotland, to work out a deal to help his business. Under the arrangement they came to, Mr. Hogg could periodically draw more money from his account than he had in his deposits. In return, the bank would charge him interest on the negative balance. They invented what's known today as an overdraft. While this overdraft service proved beneficial to both parties, in this example of Mr. Hogg and the Royal Bank of Scotland, this was not true in all cases as more banks began offering this product. Some businesses without sound revenue and business practices found themselves taking on more debt through overdraft than they could repay. Importantly, this service was created in the context of providing liquidity to businesses with sound revenue but poor cash flow. And today, financial institutions offer overdraft services to both businesses and consumers. Overdraft services have evolved significantly over the past 240 years or so, but the core concept is the same. And many of the fundamental issues we will be discussing today are not new. In fact, we dealt with this very issue about 10 years ago, and every so often we should address this to see where we are. However, the current scale and growth of overdraft and non-sufficient fund fees has caught the attention of consumer groups, this committee, and the regulators. In an average year, consumers in the United States pay around $10 to $12 billion in overdraft fees and non-sufficient fund fees, and just 9% of consumers make up 80% of those overdraft fees. Additionally, these types of fees impact people of color at a disproportionate rate. Studies have found banks with branches in predominantly black neighborhoods charge more for overdraft on average, and black customers are overrepresented in those who report paying more than $100 in fees in the past year. In December, the Consumer Financial Protection Bureau published data suggesting many financial institutions are overly reliant on the revenue that they receive from overdraft fees. However, the market is changing. Recently, many banks and credit unions voluntarily adjusted their overdraft programs to eliminate or reduce fees or create better consumer protections and more transparency. Additionally, many non-bank fintech companies are also offering products aimed at helping avoid overdraft by improving notifications and information provided to consumers or partnering with depository institutions to offer no or low fee accounts directly to consumers. This initiative is another program gaining momentum in recent years is Bank On. This initiative is a partnership between the Cities for Financial Empowerment Fund, financial institutions, and local governments with the goal of providing low-cost, basic bank accounts to the unbanked and underbanked households. These accounts do not allow overdraft fees. We have two bills noticed with today's hearing, H.R. 4277, the Overdraft Protection Act of 2021, by Ms. Maloney, who has been a champion on these issues, which would strengthen protections and disclosures for consumers with respect to overdraft fees. Additionally, we have a discussion draft entitled Expanding Access to Affordable Bank Accounts, which would require larger financial institutions to offer at least one bank account option that does not charge consumers overdraft and non-sufficient fund fees. With that, I will yield to the gentleman from Missouri, the ranking member, Mr. Luke Demayer, for his opening remarks.
Thank you, Mr. Chairman, and thank you for having this hearing today on this important topic. On December 1st, 2021, the CFPB issued a press release on overdraft fees titled, CFPB Research Shows Banks' Deep Dependence on Overdraft Fees. This press release alludes to exploitative fees being charged by financial institutions for overdraft products and went so far as to specifically name and shame 3 financial institutions. To back up this claim, the CFPB put together 2 data sets on overdraft and non-sufficient funds fees. One data set is from 2014, 8 years ago, and fails to consider new innovations in overdraft. And the other data set shows that revenue from overdraft and NSF fees only represented 2% of bank revenue in 2019. The CFPB's own data would suggest financial institutions, in fact, are not deeply dependent on overdraft fees. The truth is, overdraft is a legitimate short-term liquidity product that provides a vital service for consumers. According to a study by global data intelligence firm Curinos, consumers make highly informed choices about when to use overdraft services based on account information and clear disclosures of fees and procedures. Even President Biden's acting comptroller, Sue, acknowledged the importance of overdraft products when he said, and I quote, "Limiting overdrafts may limit the financial capacity for those who need it most," end quote. Latest actions from the CFPB continues a dangerous trend from my colleagues on the other side of the aisle. At a time when 50% of Americans would have difficulty paying a $400 emergency expense, the actions of this committee and financial regulators aim to reduce consumers' ability to access short-term liquidity financial products. Congressional Democrats and administration have regulated banks out of small dollar loans, are opposed to overdrafts, payday lenders, and have made disparaging comments on innovative products such as buy now, pay later, and earned wage access. So I asked my colleagues, where are the 40% of American consumers supposed to go when they need a $400 loan or $400 for any kind of emergency? I'd be happy to answer that question. To hear, the CFPB did not stop with overdraft fees. On February 2nd, 2022, the CFPB released a request for information on fees related to other consumer financial products or services, or what CFPB is calling junk fees. First, let's acknowledge there is no legal authority for the CFPB to define the term junk fee, or any other term for that matter, and there is even less authority to act as a price setter in the consumer financial market. The Bureau wants information on any fees associated with consumer financial products that seemed too high or were unexpected. These are intentionally vague terms in order for the Bureau to create a subjective measurement that has no bearing or the legality of any consumer financial product or service. Suggesting otherwise would be to insinuate private markets should not be able to set prices for products and services, which is the core principle of our economy. We don't need government setting prices for everything. The CFPB has also failed to take into account the lengthy disclosure requirements that consumer financial products already comply with under the Truth in Lending Act and fee disclosures promulgated by the CFPB itself. For example, in the RFI, the CFPB specifically lists prepaid cards as a financial product they want information on. What the Bureau and Mr. Chopra failed to mention is that CFPB issued a rulemaking that was finalized by Director Cordray in 2016, which requires multiple significant disclosures for the prepaid card industry. The CFPB is quite literally manufacturing a crisis about hidden fees for financial products when they are the very people who made up the disclosure regime. This shows the RFI is not about fees facing consumers, but is another attempt by the CFPB to denigrate legally operating businesses by any means possible and exert as much control as possible over the industries and thus the economy. It is simply a power grab. Ranking Member McHenry and I sent a letter to Director Chopra asking him to clarify many aspects of the overdraft and junk fee proposals. I look forward to asking this panel about what the role of CFPB should have in the pricing of consumer financial products. And with that, Mr. Chairman, I yield back.
The gentleman yields back. The chair now recognizes the Chairwoman Waters, the full chair of the Financial Services Committee, for 1 minute for her remarks.
Thank you so very much, Chair Perlmutter. Well, for far too long, banks have been charging excessive overdraft fees. And of course, I'm very troubled by consumers of color paying twice as much in fees as white consumers. So I want to commend Representative Carolyn Maloney for her steadfast work in proposing the overdraft reforms we are considering today. We've also not been shy conducting megabank oversight, pressing their CEOs to reduce and eliminate these costly fees, many of whom are beginning to do just that. With a strong CFPB supporting our efforts by investigating junk fees like these, we now have a growing list of banks finally reducing or eliminating overdraft fees. So I look forward to hearing from our witnesses on these issues and how we should build on this momentum. I yield back. Thank you.
Gentlelady yields back. Without objection, statements from the following organizations and people will be entered into the record: the American Bankers Association, Chime, Color of Change, Consumer Bankers Association, Credit Union National Association, the National Association of Federally Insured Credit Unions, the National Consumer Law Center on behalf of its low-income clients, Terry Friedline, PhD, Associate Professor of Social Work at the University of Michigan. Now I'm pleased to welcome each of our witnesses and want to introduce our panel, 3 of whom are here in person and 2 are on video. Mr. Jeremy Greer is the co-founder and executive director of Liberation in a Generation. Mr. Greer's work has focused on racial and economic justice, and he formerly worked at the Government Accountability Office, the Local Initiative Support Corporation, and Prosperity Now. Ms. Elise Hicks is Consumer Policy Counsel at Americans for Financial Reform. Ms. Hicks was previously a staff attorney for United Policy Holders, and she holds degrees from Stetson School of Business and Economics at Mercer University, the Charleston School of Law, and Georgia State University. Mr. Paul Coonert is the president and CEO of UW Credit Union. Mr. Coonert has led UW Credit Union for nearly 19 years and formerly served on the board of directors of the Filing Research Institute, a credit union industry think tank focused on issues impacting consumer financial well-being and economic empowerment. Mr. Santiago Suero is a senior policy analyst with Unidos US. Mr. Suero serves as Unido US's institutional expert on policy solutions related to reforming banking and lending policies and consumer finance policy. Finally, Mr. Todd Zaiwiki is professor of law with the Antonin Scalia Law School at George Mason University. Mr. Zaiwiki is also senior fellow of the Cato Institute and the former executive director of the George Mason University Law and Economics Center. I'd like to welcome all of our witnesses here today. Thank you for being here. You're reminded that your oral testimony will be limited to 5 minutes. You should be able to see a timer that will indicate how much time you have left, and without objection, your written statements will be made part of the record. So let's start with you, Mr. Greer. You're now recognized for 5 minutes for your testimony.
Thank you, Chairman, Ranking Member, members of the subcommittee for holding this important hearing and for the opportunity to testify with you today. My name is Jeremy Greer. I am in a generation. Liberation Generation is a national movement support organization founding to help build the power of people of color to transform the economy. Financial institutions, and large and small, have the ability and authority to unburden their customers from junk fees, such as overdraft charges. In the fourth quarter of 2021, commercial banks and savings institutions collected over $72 billion, or 36% of their income, from fees. The assessment of these fees has become core to their business model and their profit margin. This burden has disproportionately fallen on consumers who cannot afford to pay these fees. About 9% of all consumers account for almost 80% of overdraft revenue, and nearly half of all overdrafts are made by parents with children under the age of 18. And in the age of COVID, with record unemployment and historic levels of income volatility, consumers of color who have been most hit hard by the pandemic paid over $4.5 billion in overdraft fees. Black families paid about $8 million in bank fees in 2020, while Latinx families spent $1.1 billion in fees in the same year. Also, as millions of consumers are bounced out of the financial system following the closure of their accounts due to excessive overdrafts, 1/3 of households without bank accounts have identified high fees as the reason that they remain unbanked. And the unbanked comprise nearly half of Black households. These fees operate as an abusive form of high-cost credit and are in no way better than a payday loan. To put into perspective, the CFPB found that a majority of overdraft fees were incurred on transactions of $24 or less and were repaid within 3 days, meaning that a $34 overdraft fee were charged as a loan, if it were charged as a loan, it would have an annual percentage rate of 17,000%. 17,000%. This is in no way representative of a fair and inclusive financial market. It is our recommendation that Congress and the Biden administration act to bring an end to junk fees, such as overdraft and non-sufficient fund fees. We have seen a number of financial institutions already take this critical step. In March, one of the largest banks in the country, Citigroup, announced that it will end overdraft fees for consumers. And in doing so, they called it a focus on financial inclusion, which I agree with. And as Citi made their announcement, Capital One announced that they would eliminate their bank overdraft fees in 2022. However, without pressure from Congress and the administration, we are leaving it up to banks to self-regulate while bringing in huge profits on the backs of predominantly low-wealth customers, largely consumers of color. It is time for Congress to act to relieve this burden. Chairman, ranking member, and members of the committee, I appreciate the opportunity to testify, and I'm happy to answer any questions that you may have.
Mr. Greer, thank you for your testimony. Ms. Hicks, you are now recognized for 5 minutes for your testimony.
Thank you and good morning, Chair Perlmutter, Ranking Member Demayer, and members of the subcommittee. As a proud former military spouse of a specialist in the United States Army, I know firsthand that running a household on military pay can be quite difficult for lower enlisted personnel. Every month, my husband, who had opted into overdraft protection at one of the top 20 big banks, watched his pay be eaten up by $35 overdraft fees. A cycle that continued paycheck after paycheck until I, a DC licensed attorney who was stationed in California, was able to find employment after jumping through strenuous licensing requirements for the state. My husband and I are not alone. Overdraft fees are paid the most by people who can least afford them. These are fees that, 1, bear no relationship to the cost banks incur in covering overdrafts, 2, have the potential to explode into hundreds of dollars in fees, and 3, can be near impossible to avoid for people living paycheck to paycheck. According to the research from the CFPB, overdraft fees have become a cash cow for financial institutions. In 2019, banks and credit unions charged more than $15 billion in overdraft and non-sufficient fund fees, with these fees making up a particularly large portion of smaller banks' net profits. This money is mostly made off the backs of some of America's most financially vulnerable families, disproportionately affecting communities of color. Overdraft fees are a penalty for being poor or financially insecure. Nearly 80% of overdraft fee revenue to banks come from 9% of bank accounts. The median account balance for this group is less than $350. It is extremely challenging for people with low balances to avoid being hit with an overdraft fee. The timing of when debits and credits are posted to a checking account is opaque, complicated, and out of the consumer's control. And in the past, some banks have changed the order of certain transactions so they debit from largest to smallest to increase the number of overdraft fees triggered. Overdraft fees should not be used as high-cost forms of credit and should be eliminated, returned to an occasional courtesy for covering check or pre-authorized electronic payments. Banks should be allowed to impose no more than 6 overdraft fees a year. Beyond that, they should cover overdrafts through overdraft lines of credit with a reasonable interest rate instead of a huge overdraft fee. Unexpected and high fees like overdrafts are often cited as a reason for formerly banked persons to no longer have a bank account. When a bank hits a negative balance with repeated overdraft fees, it can make it impossible for the consumer to recover, so the bank will close the account. When the account is closed, the financial institution submits the customer's name to a database that acts like a blacklist, which can prevent the customer from opening a new account elsewhere for several years. Among people with checking accounts, Black and Latino Americans are more likely than white Americans to incur overdraft fees. It is wrong that a person who is struggling to get by get exploited with a surprise $35 fee just because they inadvertently overdrew their account while buying milk. Some banks have made significant changes to their overdraft programs, with a small number eliminating all overdraft fees, others getting rid of non-sufficient fund fees, and some making more modest changes like 24-hour grace periods. While this is positive for the bank's customers, these measures are insufficient by themselves. We need financial regulators to take decisive action to stop abusive overdraft fees at all financial institutions and to prevent them from coming back. Harmful overdraft practices remains a systemic problem that policymakers should address. Unless fair, legally binding rules for overdrafts are established, abusive fees will remain. We also need to look out for new fintech forms of overdraft fees, like fees hidden as purportedly voluntary tips. We urge representatives to co-sponsor and support Representative Maloney's Overdraft Protection Act and senators to support Senator Booker's Stop Overdraft Profiteering Act. These bills will cap the number of overdraft fees at 1 per month, 6 per year, while allowing additional overdrafts to be covered through overdraft lines of credit. We also urge the CFPB to use its rulemaking authority to end abusive fee practices and to ensure that consumers are safe at every bank and credit union. We also urge the federal financial regulators to use their supervision and other authorities to address this problem. And we urge members of Congress to highlight the importance of the actions taken by these regulators. Thank you for inviting me to testify, and I will be happy to answer your questions.
Thank you, Ms. Hicks, for your testimony. Mr. Coonert, you are now recognized for 5 minutes for your testimony.
Good morning, Mr. Chairman, ranking members, and members of the subcommittee. Thank you for the opportunity to testify. My name is Paul Coonert, and I'm the president and CEO of the University of Wisconsin Credit Union, and I'm testifying today on behalf of my organization. UW Credit Union is a state-chartered, federally insured financial institution. We have assets of $4.8 billion and are among Wisconsin's top 10 financial depositories. We operate primarily in the Madison and Milwaukee communities. We have about 310,000 members, 875 employees, and 29 branch locations. I've provided written testimony in advance of the hearing, so I'll be brief in my comments. As a not-for-profit credit union, we believe our mission is to improve the financial well-being of our members. This mission led us to first introduce account overdraft services more than 20 years ago, and this same mission led us to be early among financial institutions in re-examining our overdraft program and responding with changes to create a more equitable banking experience. In 2001, when we introduced our overdraft program, we viewed it as a way for members to avoid bounce checks. But over the years, we observed an increase in use of the overdraft program, even though new online tools made it easier for members to keep track of their account balances. In 2009, when the Federal Reserve published an update to Regulation E, it led us to re-examine our overdraft program. About that time, too, consumer groups were questioning the value of some overdraft programs and raising concerns that the fees most often fell to those who least could afford them. As a result, we made changes to our overdraft program in 2010, including implementing a de minimis grace zone of $10, setting a limit of 1 fee per day, and we also affirmed that we would not ask members to opt in to pay overdraft fees related to debit card transactions. We saw a significant decline in overdraft fee income after these changes. Over the next decade, we introduced additional types of accounts that help consumers avoid the possibility of overdrafts altogether. Then in July 2021, we implemented a reduction in the remaining overdraft fee to just $5. Here's what led us to lower the fee. During 2020, overdraft programs were again frequently in the subject of financial industry news stories. We also witnessed social unrest that prompted us to think more deeply about racial equity and to consider business practices from an equity point of view. Also, we were influenced by research which showed that lower income households, particularly Black and Latinx households, were more likely to use overdrafts. We also reviewed our costs again in providing overdraft services. In short, our review led us to believe that a $5 overdraft fee, limited to 1 per day, would be sustainable for us. It's important to confirm that none of the changes that we have made have reduced the availability of overdraft funds to our members. My written testimony includes more details on all this, so I'll just summarize and say, when prices are fair, we believe consumers do benefit from access to the credit provided by overdraft programs. Thank you for the opportunity to testify today, and I look forward to your questions.
Thank you, Mr. Coonert, for your testimony. Mr. Suero, you are, and if I'm making mincemeat of your name, I apologize. Please state your name for the record, and you are now recognized for 5 minutes.
Thank you, Mr. Chairman. Good morning, and thank you for the invitation. I am Santiago Suero, Senior Policy Analyst at Unidos US. It's okay, people get it wrong all the time. Unidos US, formerly the National Council of La Raza, the largest Hispanic civil rights and advocacy organization in the US. For more than 50 years, we have advanced opportunities for Latinos. We also partner with nearly 300 affiliates from Colorado to Missouri, small towns in Texas and Florida to big cities on our coasts. Our affiliates are local community organizations from across the country that directly serve Latinos. Latinos are in a precarious moment. The federal government's response to the pandemic was critical to reducing poverty and supporting low-income people. But as supports like the child tax credit expire, many are struggling to make ends meet. Recent data shows that over the last 7 days, roughly 63 million people had difficulty covering expenses, and this afflicts 38% of Latinos compared to 23% of whites. Yet the work of Latinos is fueling the country's economic recovery. Latinos start businesses at more than double the overall rate and wield significant purchasing power. As such, low-income people must not be burdened with unfair and unnecessary fees. We are encouraged by recent announcements by some banks that they are reducing or eliminating overdraft and non-sufficient fund fees. These actions are in part a result of renewed attention from regulators, in addition to pressure from consumers in a competitive market. But because they are voluntary, they could be reversed if conditions change. For this reason, we strongly encourage policymakers to establish permanent guardrails to ensure a competitive and fair marketplace for low-income people, including Latinos. We have 3 overarching observations that inform our work on overdraft. First, most people who incur multiple overdraft fees make less than $50,000 a year, and this group is disproportionately comprised of Latinos. Second, high overdraft and non-sufficient fund fees are a barrier to entry for unbanked households. Third, a mix of careful regulations and market-driven solutions can improve access to banking services, resulting in a win-win situation for the industry and consumers. Overdraft fees by nature impact consumers when they can least afford an additional cost. They are also predominantly a fee charged to the lowest income consumers. So consider that research shows that Black and Latino households are far more likely than white households to overdraw an account, and low to moderate income households are nearly twice as likely as higher income households to overdraw an account. Overdraft fees have implications for those outside of the financial mainstream. As of 2019, roughly 7 million people were unbanked, 12% of Latinos were unbanked, and this is compared to 2.5% of whites. Cost is a major barrier to obtaining an account. Some 34% of those who remain unbanked say they do not have a bank account because of high fees, and 31% say fees are too unpredictable. 2 policy change pathways could help make the marketplace fairer and more dynamic. First, excessive fees should be limited by regulatory approaches, which could include limits on multiple fees incurred for the same incident, caps on total fees, reasonable grace periods to cure an overdraft, and for example, the Overdraft Protection Act would limit overdraft fees significantly. The Consumer Financial Protection Bureau is taking an interest with the recent request for information focused on so-called junk fees. Second, we should deepen support for institutions with more inclusive and affordable bank products. Community development financial institutions and minority depository institutions offer such products. And we know of many credit unions that go to great lengths to include Latinos in their institutions, including offering low-cost products. Congress should therefore consider increasing appropriations funding for the CDFI fund program, allowing them to grow and serve more low-income consumers. Yet, the CDFI fund needs complements to grow the field to meaningful levels. The Advancing Technologies to Support Inclusion Act would invest billions of dollars in CDFIs and MDIs to upgrade their technology capabilities, and this would significantly improve their ability to compete with banks that offer fintech products. Finally, policymakers should incentivize banks to sign on to bank-on national account standards, and banks should promote these no-overdraft, low-cost accounts in underserved communities. Some of our financial institution friends said there should be a race-to-the-top business strategy as the path forward for the banking sector. We agree with the sentiment that investing in low-income people by providing affordable and high-quality products will allow communities and banks to grow together. Thank you, and I look forward to your questions.
Thank you, Mr. Suero. I appreciate your testimony. Now we'd like to hear from Mr. Zaiwiki. Is it Zaiwiki or Zaiwiki?
Zaiwiki.
Zaiwiki. You are now recognized for 5 minutes for your testimony.
Several trick names on our panel today, so
yes.
thank you. Thank you, Chairman Perlmutter, Ranking Member Demayer, and members of the committee. I understand consumers are frustrated by overdraft fees, other bank fees. Banks and financial products for consumers today are extremely complex for various reasons and have a lot of price points. But the point I hope you will take away from today is that exasperation is not a substitute for sound economic analysis. And I think this is an area in which unintended consequences of bans on overdraft protection, substantive limits, price controls, and the like could have some serious unintended consequences. So I'm going to talk about unintended consequences briefly on three groups, which are first, those who use overdraft protection, second, banks, and in particular small banks, and third, all other consumers who don't use overdraft protection, and particularly lower income consumers who I think would be most adversely affected by unwise or extreme new limits on overdraft protection. First, who are these people who use overdraft protection? I have detailed this in my written testimony, but I'll just give a brief overview here, which is first, these are individuals who have limited access to credit generally. The CFPB did a study in 2017, and they found, or they confirmed what had previously been found, which is the primary predictor of whether somebody frequently overdrafts their account is their credit score, and that people with low credit scores use overdraft more frequently. It is not correlated with income and other demographic characteristics. There are a lot of low-income households in this country who manage their financial affairs fine and never overdraft their account. And I think that's important to keep in mind. People who use overdraft a lot are also people who do not have access to credit cards. And if they do have access to credit cards, they have much less credit access on their credit cards. And so most consumers use credit cards for short-term expenses. They cannot. The second thing we know about these people is that they generally use overdraft. Heavy overdraft protection users use that for what we could be called necessities. Michael Flores and I did research. We looked at MCC codes, merchant codes. We found that overwhelmingly the places where people overdraft are grocery stores, gasoline pumps, and the like. Other studies have found it's for things like utilities, rent, mortgage, groceries, and the like. The third thing is that, as I mentioned, there seems to be very little correlation between heavy overdraft usage and income. In fact, what we find is that higher income households, is measured by households that make a lot of deposits each month, are actually more likely to be the households that overdraft. What we see is that what causes overdraft, it appears, are households that have high income and high deposits, but also just a lot of deposit activity on their account. They have a lot more debit card transactions and the like, and low average balances. So we're talking about people who just have a lot of income volatility, but they do not appear to be lower income. They tend to be higher income, or at least higher deposits. The fourth thing we know about people who use overdraft protection a lot is they monitor their accounts a lot more closely. They understand that they are skating near the edge. And when they overdraft, they typically understand that they either are hoping that it'll work out and then a deposit will hit before a withdrawal, or they know it will not. They check their accounts regularly. They are much more active in checking their accounts. The second group this hits are small banks. Banks, as we've heard, generate a lot of revenue from this, but what we have found, and I can elaborate on this questions if you'd like, is that small banks tend to be more dependent on overdraft fees than large banks. Why? Because large mega banks have multiple lines of revenues, wealth advising services, insurance, all these sorts of things. Small banks will have a much more difficult time diversifying if they lose this stream of revenues. The third thing, and one I want to close on, is to talk about the impact on other consumers who don't use overdraft protection. which is if we get rid of overdraft protection and banks move to pick up revenues somewhere else, what are we going to see? We'll see higher bank fees. We'll see higher minimum monthly deposits as basically insurance against overdrafting, and we will see a loss of access to free checking. And this will impact low-income households the most. A paper by Evans, Lighton, and Schmalensee found that when the Fed changed its rules on opt-in to overdraft protection, the percentage of free bank accounts fell 11 percentage points in 1 year. That impacts low-income consumers. We also have the study by Douglas, Meltzer, and Morgan that I would refer you to, which is they found when overdraft fees were essentially deregulated, what happened there was a decrease in return check fees and an increase in bank accounts by low-income households. So thank you for your time, and I look forward to taking your questions.
Mr. Zaiwiki, thank you for your testimony. The chair will now recognize the chairwoman of the entire Financial Services Committee for 5 minutes for her questions.
Thank you very much, Mr. Perlmutter. I'd like to address this question to Mr. Greer. Mr. Greer, in his written testimony, states that elite institutions use racism and discrimination as a tool to expand their power and wealth, all while suppressing economic power of communities of color and other marginalized groups. These elite institutions that control resources use that control to change the rules of our economy in their favor, which continues the cycle of profit. You describe your work as basically liberation of oppression, of the oppression economy. So now, many of the large banks have announced changes to their overdraft programs. However, these programs do not all eliminate the use of overdraft fees and provide different features. For instance, some large banks are now offering new small dollar loan products to their customers as part of the changes. What are the most important considerations when evaluating and comparing these different programs that the banks are now offering in lieu of more traditional high-cost overdraft fees? Mr. Greer?
Thank you. Yes, I'm here. Thank you, Chairwoman, for that question. It's so important. And the perspective that you laid is exactly the assessment that we have of the economy. I think there's a long history of the financial institutions of this country oppressing people of color, whether that's in the mortgage market, whether it's in retail banking, so on and so forth. And we still see it today. And we see examples of it today in the news. It feels like almost monthly to weekly. What I think is the most important thing to consider is, as financial institutions are served, is recognizing and understanding that they are navigating a very turbulent economy, especially now in the time of COVID. You know, more income volatility, more volatility around the hours that they're able to work, being pushed into the gig economy, and structuring products and services to meet those needs for folks are things to consider. And one thing that I'll raise, and Ms. Hicks raised it in her testimony, is access to affordable credit. And I'd say access to affordable credit that is not predatory, but that it actually help people manage their finances and actually build wealth. Because what we know for historically is, you know, these fees have become a substitute for folks who cannot access affordable credit in financial institutions because of discrimination in the credit market. So what I'd say is that we can't look at these things in a vacuum. It's very easy to say that, like, well, if we do this, then this will happen, or we do this and this. We have to look at the whole picture and know that, like, the financial institutions have a responsibility to meet the full needs of communities that they serve. And
do you believe that because of these practices, the wealth gap can never be closed, in fact, if these kind of practices continue?
Absolutely, because what these fees are doing is they're extracting resources out of the households of communities of color that would otherwise could be used to save money, to put money down on a mortgage on a house, to put money down on a small business, to participate in the economy in a way that builds wealth. But they're not able to do that because fees like these and other things that financial institutions do that this committee and others have covered over time are just pulling and extracting and siphoning resources out of communities that could be used to build wealth.
The amount of money that you indicated that has been paid by Black and Latino communities is absolutely extraordinary. Do you stand by that?
It's what we found in the research in preparing for this hearing.
I think about $40 billion you indicated in one instance here with the Black community?
Oh, it was 800 million and 1.1 billion in bank fees in 2020.
Thank you very much. Mr. Chairman, I yield back.
Gentlelady yields back. The gentleman from Missouri, Mr. Luke Demayer, is recognized for 5 minutes for his questions.
Thank you, Mr. Chairman. Professor Zaiwiki, someone who served as the chair of the CFPB's task force on consumer financial law, do you think the CFPB has the legal authority to set the prices for consumer financial products?
I don't think they have the legal authority to set the prices on financial products. And as we know, Dodd-Frank specifically says they cannot impose usury ceilings. But I would think that would be a general a rule in terms of dictating prices for financial services.
So why are they getting involved in this?
They have this theory of junk fees, and I assume the theory must be something like that these are unfair, deceptive, or abusive practices. It's not quite clear what their authority is for it, but basically what we've had is rhetoric so far.
Yeah, it's very concerning to me when you have an agency like that basically creates a new word. I've been around the financial service industry for almost 50 years. I've never heard the word junk fees. It's not in any financial services dictionary of anywhere. They've created this word, and basically what I think you just said, they're trying to insinuate that there is some sort of exploitive activity going on here, rather than acknowledging that service charges are basically something that is a service that's been requested by the customer for which they pay a fee. They don't pay fees if they don't access the service, do they not?
That's right. All these fees are generated by something people do. But the more general point, I think, Congressman Luke Demayer, is a sound one, which is what is a junk fee versus a risk-based fee, for example? If I go off to Europe and incur a foreign transaction fee, should some guy, some poor guy in rural Nebraska be forced to subsidize my foreign transaction fee? If I overdraw my account, why should somebody else have to pay for my overdrafts? If I pay my credit card late, why all of a sudden is that a junk fee rather than something that prices my risk and forces other people, prevents other people from having to subsidize my behavior? And so I think the junk fees rhetoric covers a lot of serious economic questions.
But we see, over the last several months here, it really is concerning to me to see the activities of the CFPB and the way they're going about business. Is, for instance, they set up this straw man issue, and suddenly the other day they talked about illegal repossessions, which is they've created a whole situation here that doesn't exist, and so, but we have to regulate that. We create service fees for financial institutions as junk fees, so therefore we have to regulate that. There's nothing there, and yet they try and create something so they can make an excuse to go regulate it when even you've just said they don't have the authority to do that. It is very concerning by the way they're going about their business, how they're exploiting their lack of oversight to be able to go about doing this. It is very, very concerning. I'm just curious, if there is no overdraft situation, what happens to people if they can't have access to overdraft services? What are they going to do when they have 40% of the people can't pay a $4 bill, and you wind up tonight with having to go buy some new set of tires and it costs $500 tomorrow?
Well, that's right. Basically, they will either have their payment declined, in which case they won't be able to buy the goods or services they need. As I said, overwhelmingly, it looks like people use overdraft for things like groceries, utility bills, and the like. The second thing they could do is try to go somewhere else. And for a lot of consumers, what we've already said is they don't have access to credit cards. And what a lot of heavy users of overdraft have said, their next best alternative is a payday loan. So either go without, or they have to go down the street and get a payday loan in order to buy the tires. And it's not clear to me how that makes them better off.
So you made a comment a minute ago about, if they don't charge a fee for this, the rest of the customers who patronize that particular business are going to have to pay for that person's ability to have a free loan through higher service fees that they pay. Would that be a fair statement?
That's basic economics 101.
Because at the end of the day, there is a certain amount of expense that the business has that they have to cover with their charges for their business operations, whatever the business model is, and it includes some fees to be able to pay for the people who work for them to be able to do that. To me, it's a simple way of operating. It's a business model. It's been there for years. It's nothing exploitive about it if you understand how it operates. I mean, I was in the business for a long, long time, and I can tell you, people call up and say, hey, Blaine, I wrote a check today. I'll be in next week to fix it up. Please pay my check so I don't have an overdraft fee, or so I don't have a bad check fee, and I can do business. They're willing to pay the fee to be able to transact that piece of business. So with that, thank you, Mr. Ricky, for your testimony today. Mr. Chairman, I yield back.
Thank you.
Thank the gentleman. Now I'm going to recognize myself for 5 minutes. And, at this committee, I've said to people from time to time, I think we have two responsibilities. It's consumer protection of financial institutions. One of them is to weed out and stop sharp practices. Now, I would say that's something as a bankruptcy lawyer, we heard a lot about it. So bankers and bankruptcy lawyers, we heard about sharp practices that take advantage of everyday Americans and put them behind the 8 ball where they really have trouble, exiting. The other is to make sure that the financial institution remains solvent and strong. And those are not incompatible. Those things work together. So I'm going to start with you, Mr. Coonert, if I may. I want to ask you about some of the consumer protections your credit union has implemented to your overdraft product. Beginning back in 2010, University of Wisconsin, UW Credit Union, implemented a de minimis overdraft buffer, published a plain language description of the product, and made other changes to make the product more consumer friendly. As you mentioned, you also recently cut your overdraft fee from $30 to $5. Many of these steps your credit union has taken are emblematic of changes many of my colleagues and I would like to see in the market overall. I think a lot of other financial institutions are taking a close look at their overdraft programs, and hopefully we will see continuing improvements in this area. What has been the most challenging part of improving your overdraft program?
Thank you, Mr. Chairman. Well, the most challenging part is adapting to not having the revenue that the programs previously provided us. The revenue from overdraft programs, especially those that include debit card transactions, can be pretty significant to a financial institution. So we voluntarily made these changes and made them, as you mentioned, starting 10 years ago. So we've had time to adapt our organization to not depend on that overdraft income. I think operationally, it hasn't been as difficult to implement changes as it is just to adjust a business model where that revenue isn't a part of it.
How have your customers reacted to the changes that you've made over this period?
Honestly, they've responded quite quietly. We didn't have a lot of complaints about practices before 2010 or even since. Obviously, people have benefited from the more affordable cost of the program, and that's been a positive. We enjoy very high member satisfaction levels overall, but we have received over the years very little feedback one way or another on these programs. But we believe in principled decisions and don't necessarily make them based on public outcry or complaints.
You said these provide a significant revenue stream. I heard Mr. Greer at the beginning of his testimony talk about the $34 charge paid back in 3 days on a whatever cup of coffee or what it is, at a 17,000 per APR, annual percentage rate. So, Mr. Greer, do you think these revenues that, people get stuck in it, is that what is it a revenue stream that the banks are becoming dependent upon, I guess is what I would ask you? Or a bank, any banks?
Yeah, I think dependent upon is, I think it's pretty clear it's a significant portion of their revenue that's coming in. Now, dependency on that revenue doesn't, to me, justify the extraction that it's taking from households, particularly households of color. You in Congress have to understand the trade-offs of that. The financial instability in the household that these fees are causing households, to me, wouldn't be commensurate with the adjustments that financial institutions would have to make in order to forego some of the revenue that they would lose by not by eliminating these fees. So again, I think the trade-off for families is they're much less able to stomach the impact of these fees than a bank would be for cushioning the impact of the loss of revenue.
Thank you. My time is about to expire. I will yield back and recognize the gentleman from Florida, Mr. Posey, for 5 minutes for his questions.
Thank you very much, Chairman Perlmutter. Professor Zaiwiki, is there any way to be charged an overdraft fee if you don't write bad checks?
Not that I'm aware of.
If there was no fee to cover bad checks, who would have the burden of making up lost revenue and administrative costs?
And that's a great point, Congressman Posey, which we have to keep in mind. The overwhelming majority of Americans never or rarely overdraft their account. And so we're talking about most people don't do this. But if we have a situation in which people are writing bad checks that have to be cashed off, or payments that are made that have to be cashed off, an overdraft line of credit might be $300, $400, $500. If people don't have to pay for that and that ends up getting written off, somebody else has to bear that cost, and that means that other 80% of households, presumably, who aren't really using overdraft very often.
So when we're talking about the title of this hearing, the end to overdraft fees, examining them, the movement to eliminate the fees costing consumers billions. I mean, so if we do that, we shift the burden of responsibility from people who write bad checks to the backs of people who don't write bad checks. Do I get that correct? Am I anywhere in the ballpark right on this?
That's right, is the rest of us have to pay for it. And what really bothers me about it, and what I'm most concerned about, Congressman Posey, is the impact that this would have on all consumers, which is to say, one way of keeping people from writing bad checks is, for example, requiring to hold higher minimum balances in their accounts, so the checks are more likely and payments are more likely to clear. Who's that going to hurt? That's going to hurt low-income consumers. You could charge bank fees for everybody, monthly fees, in order to provide this, quote, free service. Who's that going to affect? It's going to most likely affect lower-income consumers because they're not going to be able to get the minimum balances necessary to maintain free checking and the like. And so there's no free lunch here. There's no free lunch, unfortunately, for when you overdraw your account, somebody has to pay for it.
Historically, we only subsidize things that we want to encourage, and I wouldn't think we'd want to encourage writing bad checks, but it's almost comical when you stop to think about it that the management of an organization that's $30 trillion in debt with no plan whatsoever to ever repay that money, just continue to pay interest and burden future generations, is trying to tell banks and credit unions and other lenders how they should run their business. I mean, that almost doesn't pass a straight face test. I have a real problem coping with that. Would it be reasonable and beneficial for banks to characterize overdraft fees to become a short-term line of credit with transparent limits on the amount of available credit and the prices of that credit?
What I think would be a useful way, a more productive way to think about this, Congressman Posey, and I feel very strongly about this. We talked about this in our CFPB task force report. I think the answer to this is more competition, which is it's regrettable that if you can't get an overdraft transaction, you have to go get a payday loan. I think the answer is to open up things like fintech, greater chartering of credit unions, more access to different sorts of banks like Walmart being given a banking charter. I think that earned wage access, as we talked about, direct deposit advance. And I also think a very important thing that was mentioned in some of the background materials this hearing is it is time for the Fed to get its act together on faster payments. Somebody needs to get this faster payments problem solved. The rest of the world knows how to do faster payments. Why can't we do faster payments so that it takes 3 or 4 days for your paycheck to clear in a bank? And I don't know whether it's the Fed or whether it's the clearinghouse or somebody, but there are a lot of things that could be done to promote competition and promote access, I think, without going down this path of banning products, price controls, and things that are going to have terrible unintended consequences for people.
Well, I thank you, Professor, and my time is about to expire, so I'll yield back, Mr. Chairman.
Gentleman yields back. The chair now recognizes the gentleman from Texas, Mr. Greene, who is also the chair of the Subcommittee on Oversight and Investigations, and you are now recognized for 5 minutes for your questions.
Thank you, Mr. Chairman. Am I audible, Mr. Chairman? Can you hear me?
Yes, but try to speak up a little bit. It just, but you're pretty audible, but you're going to have to just be a little louder. Thanks.
I'll be as loud as I can. How is that?
Good.
Thank you, Mr. Chairman. Mr. Chairman, I'm grateful for this hearing, and I especially want to thank you and the chair of the full committee. I am just amazed at how this hearing has unearthed facts that are so disturbing. And I want to mention this, the chair of the full committee, if I may, the Honorable Maxine Waters. When it comes to housing the homeless and consumer protection, nobody's in front of her in that line of persons who desire to do so. So I'm grateful to you, Madam Chair. It's an honor to serve under your leadership. With reference to the free lunch, no free lunch, let's talk to Mr. Coonert. Mr. President, you have been without these overdraft fees for some time now. Are you at risk of going out of business?
No, I'm happy to report that we're doing very well.
How do you respond to a comment about no free lunch when it comes to doing something that obviously benefits your clientele?
Well, we did not eliminate the overdraft fee entirely. Our action was to change the likelihood that it would be imposed, make sure it wouldn't be imposed more than once a day, and study our actual costs and make sure that the fee we were charging was proportional and appropriate for the service we were providing. We do provide our account holders between $200 and $600 of liquidity through these programs. And so we, to be sustainable, believe that we needed to charge something. It wasn't possible for us, or wise, I should say, we didn't think, to charge nothing for the fee, because we think there should be a greater cost to receiving an advance from the credit union than not receiving one. And I think that goes to some of the comments that have been made about fairness to all the members that we serve. But it isn't we're not serving all our members well to, we think, to disproportionately profit from one segment of our membership simply to benefit another. We do think that we need to be diligent in monitoring the levels of income that we receive from the various products we have.
Well, I'm grateful that you've given some consideration, to be very candid with you. I have one more question for you, and then I'll have to move on. In doing this, how much less are you charging the persons that you're referencing? What was the fee initially, and what is it now?
We made substantial changes to the likelihood you would incur a fee, and no more than one 10 years ago. But last year, we reduced the fee from $30 to $5. $30 we were comfortable with that amount in 2010 because it was, at the time, sort of considered the competitive market rate for an overdraft. Our focus was to make sure you wouldn't incur that from a debit card transaction. It would be purely from a check transaction or a ACH debit. But then it was last year that we reduced the fee after more examination of the program.
And you are maintaining your business model and doing well.
We are. Thank you.
Thank you. Mr. Greer, let me go to you rather quickly. You indicated that these fees, persons usually would have $24 or less in their overdraft and that they will be repaid in about 3 days. And I think you said that that interest rate annually would compute to about 17,000%. Correct my mistake, because I think this is great information for me for future reference.
No, that's correct, Congressman.
And $24 or less, and what would the typical amount of the overdraft fee be for this $24 or less?
Yeah, anywhere underneath that $24. So you're talking about, and it is correct, like routine kind of purchases at the grocery store, carton of milk.
I guess what I'm asking is what would the fee that the bank would charge for that?
Oh, they would charge $34 on, say, like a $5 overdraft.
$34 on a $5 overdraft.
Yeah.
Okay. Well, I thank you, Mr. Chairman, and I yield back.
Gentleman yields back. The chair now recognizes the gentleman from Kentucky, Mr. Barr, for 5 minutes for his questions.
Thank you, Mr. Chairman, and thanks to our witnesses for their testimony today. And as the discussion has progressed, I notice a theme continues to come up, and that's the benefit of short-term liquidity for consumers provided by these overdraft eligible accounts. And ahead of this hearing, I asked many of my constituents, Kentuckians, for some anecdotes about their experiences with bank accounts and overdraft fees, and I got a whole lot of feedback. And one of them I just have to share. There were a couple of brothers, and they were horse traders. Kentucky is synonymous with horses. And these guys, they would buy Western performance horses for cutting and reining, and they bought them for about $3,000, and they sold them for $5,000. They had short-term liquidity needs, and they sometimes paid the bank $1,000 in overdraft fees and negative balance fees. But they wanted to do it. They knew that they were going to have to do it. They didn't qualify for a line of credit, so they wanted to do this because they had no problem paying a $30 overdraft fee to buy a horse that they would then make $2,000 on. They knew about this product. They liked the product, and the bank had a problem with it, not because the bank didn't believe that these folks were going to pay them back, but because the regulators had a problem with it. That's why the bank had a problem with the overdraft. Another great story from a Kentuckian. And it's one thing to speak about these fees in the abstract, but it's a totally different thing to hear about what happens in reality and to hear it directly. A young mother, husband was deployed in the Army, and the car broke down. She had no way to pay for the car repair, but forgot that she didn't have sufficient funds in her checking account. The overdraft protection on that account allowed her to address her emergency. And she relayed that that fee that she paid was worth the convenience in the circumstance. And I've heard many other stories similar to this one. Professor Zaiwiki, in a circumstance like the one I just described, what options would be available to that young mother whose husband was deployed overseas? What alternatives would she have if accounts with overdraft protection were banned? What would be the alternative for her as she faced that short-term cash-strapped need?
Well, what we know is that you've asked most people, including people in this room, we would just use a credit card, right? Credit cards that's what credit cards are for. But people who use overdraft are, by definition, they say we don't have credit cards. I think we need to understand, according to the CFPB, people who overdraft their accounts frequently have a credit score of 563. 563. These are deep subprime. And so when we're talking about overdrafting, extending $300, $500 of credit to someone, these are accounts that go bad. These are overdraft accounts that go bad, which is why you charge a fee on them. And these are people who are not going to get a credit card. So for this young woman, presumably if she had a credit card, she would have used it. She didn't. And so her alternative is probably a payday loan is the best she's going to do at that point, or going without.
And to that point, this woman saw her banker at a grocery store and went up and thanked the banker for the convenience that overdraft protection provided. Professor Zaiwiki, can you describe the requirements for banks under Regulation E with respect to overdraft fees and the transparency and protections that those rules already provide to customers?
Right. Well, there's already a lot of disclosures that are required with respect to point of sale and ATM overdraft fees. We know they changed the rules so it's opt-in, and so consumers have to actually opt into that. And unsurprisingly, what we see is the consumers who use overdraft protection a lot were a lot more likely to opt in when that was passed because they have the greatest need for the product.
You know, in the final minute, I want to focus on another point that you made and the ability of community banks, small banks, to handle overregulation of overdraft versus large banks. It's wonderful that we heard from one of our witnesses, Mr. Coonert, about his institution's ability to reduce those fees, and that's the great thing about a competitive marketplace. And presumably because of that move, maybe his institution is able to attract more customers. That's his choice, and that's what the free market and competition does. But can you compare the relative ability of large banks and small banks to absorb the costs of overdraft protection if fees are further curtailed or prohibited?
Yeah, I think it's great that banks are innovating on this. They're competing. If large banks want to be more generous on overdrafts, that's great. Like, let 1,000 flowers bloom. But the reality is that larger banks have a lot more places they can generate fees from. And so one of the big ones is small banks have continued to be able to be competitive because they offer no annual fee bank accounts, right? Large banks have generally moved away from that. And
Mr. Zaiwiki, his time has expired. Thank you. And just anecdotes, you reminded me, Mr. Barr, of my daughters buying their cup of coffee at Starbucks, overdrawing $2 and getting charged $35 on their overdraft. So, it goes, they're all over the map on this thing. I'm going to recognize now the gentleman from California, Mr. Vargas, who's recognized for 5 minutes for his questions.
Thank you very much, Mr. Chairman. I appreciate this meeting very much, and I want to thank also the ranking member. Dr. Zaiwiki, you've said a few things here today that to me sound very counterintuitive. So I want to make sure that I understood what you said and give you an opportunity to clarify them for me if I'm incorrect. You said this: who are the people that use overdraft? You said it's not correlated to poverty. Higher income families use overdraft more than lower income families, and they use it for groceries and utilities. That sounds very counterintuitive to me. I don't believe we've ever used overdraft for upper middle class family. I think you also said the great majority of Americans never use overdraft. That seems to me what you've said completely counterintuitive. Could you explain that to me?
Sure, I'd be happy to. So if you take, for example, the question about income, if you look at the CFPB's 2017 report on frequent overdrafters, what we find is that when you look at monthly deposits, very frequent overdrafters who overdraft more than 20 times a year have monthly deposits of $2,554. People who infrequently overdraft 1 to 3 times a month have $1,726 per month, so $800 more per month. And it goes down from 20 to 10 and down. It goes from 2,500 down to 1,700 linearly. What we also see is that people in that category have very low credit scores, very low available credit on their credit cards, and much higher levels of point-of-sale debit card transactions, twice as many as the people who have lower income and overdraft less frequently. So the logic seems to be, what seems to be driving overdraft protection for a lot of these people is they simply have a lot of money flowing through their accounts and things get out of whack, right? And so it would not be, unfortunately, unsurprising if there were families with kids and stuff.
Doctor, I'm going to interrupt you for a second.
Sure, I'm sorry.
Some of the other testimony that other people spoke of, people of color, especially overdrafting, doesn't seem to jive with what you're saying at all, just to be frank. I mean, this seems to me a little bit like the old lawyers that got up there for the tobacco companies and said, no, tobacco, there's no health problem here. Would someone else like to answer these questions or refute or contest what Dr. Zaiwiki has said? Any of the other witnesses?
Sure, this is Santiago with Unidos. So in that, I
Yes.
believe in the same report, we've been looking at the 9% of consumers that account for 80% of all overdraft fees. In that report, if you look at the 9% of consumers, 7 out of 10 of them earn less than $50,000 per year. So if you're looking at it in terms of income, a majority of them are relatively lower income rather than looking at it in terms of deposit amounts.
It seems ridiculous to me to believe that mostly wealthy families overdraft. I mean, that to me sounds, maybe it's not, but it seems to me ridiculous, especially if you see so many people of color who are normally not wealthy paying so much in overdraft fees. Anyone else, would they like to comment on that?
This is Elise Hicks from Americans for Financial Reform. I
Yes.
particularly agree that it does sound ridiculous that high-income families are using overdraft protection when low-income families do not own a lot of the wealth in this country. So quite naturally, the accounts that hold that are the 9% of accounts that hold $350 or less that are using overdraft protection the most do seem to go to the low-income people in the country.
I mean, that seems to me obvious. I mean, it seems, I mean, and that's why, but it could be right. I mean, I don't know. I think more should be done on that because that to me sounds ridiculous that the wealthy families are the ones that pay the overdraft and the poor do not, that it doesn't correlate to poverty. That sounds utterly ridiculous. It sounds like that old commercial for the tobacco companies. But again, my time has run out, but I appreciate this hearing very much. Thank you.
Gentleman's time has expired. He yields his time. The gentleman from Texas, Mr. Williams, is now recognized for 5 minutes.
Thank you, Mr. Chairman. Mr. Zaiwiki, do you want to quickly respond to any of those accusations?
Sure. This is CFPB data. This is a CFPB study. Michael Flores did a study that found the same thing. People with that overdraft was, again, most households don't overdraft or overdraft rarely, right? So we're talking about high overdrafters. CFPB found that. Michael Flores' study found the same thing, which is that what correlates with people is they have high deposits, high transactions, and low average balances.
And we know the CFPB is always right, so thank you. Thank you for that.
I wouldn't compare them to the cigarette industry.
It's funny we're having this hearing highlighting a phenomenon that the private sector, and I'm a private sector guy, I'm a small business owner, is already taking care of. There's a thing called competition a lot of people don't understand, but it drives the financial industry to lower or get rid of overdraft fees entirely. Customers tell people what to do, tell businesses what to do. This is not happening because of government mandates, but businesses who are competing for customers. It started with some fintech companies like Chime who got rid of these fees almost 5 years ago, and a few years later, more traditional banks like Ally changed their overdraft policy, in their opinion, but better serve their customers. And most importantly, one of the largest banks in the country, Citibank, got rid of these fees as well. So the market is naturally taking care of the issue without government intervention, and we do not need more rules from Washington mandating the entire industry moves in this direction, because I know when I opened up my first checking account, I agreed to write checks and have money in the bank before the check cleared. It's pretty simple. So, Professor Zaiwiki, in what ways do you think banks would recoup some of their lost revenues if overdraft fees were suddenly banned across the board?
Right, and let me again emphasize what you said, which I think it's great that there's different models of competition. And credit unions obviously are member organizations. They can have a different model from a bank that kind of is open to all comers. But I think what we would probably see is a reduction of free checking. We would see higher monthly required minimum balances. This is what the Douglas and other research found, was that that there was restrictions. and we would see higher bank fees, like higher monthly fees. So.
Okay, so if we legislate away overdraft fees, some private sector participants will simply block these transactions from going through at the time of the sale, and this will leave consumers, again, the very people we want to help sometimes, we end up hurting, and they'll leave consumers with fewer options, and if they are left in a pinch and do not have sufficient funds in their accounts. So we saw after Dodd-Frank, when the government came in with a heavy-handed regulatory approach, debit card rewards and free checking accounts suddenly left the market. These are trade-offs to all of these policies we enact in this committee, and we should not look at outright bans on certain products that have provided a necessary service to customers. And in Texas, we got a thing is a deal's a deal. And so, Professor Zaiwiki, what are some ways we could expand consumers' options in the small dollar credit space instead of this blanket big government ban?
I think that's the best way to think about this, Congressman Williams. I think the Durbin Amendment example is a very bright cautionary tale of how this happens, and so I would advise we look at that. But as I mentioned, I think things like fintech, I think greater chartering of industrial loan banks, such as Walmart, potentially getting earned wage access, direct deposit advance products, all these sorts of things. More competition is the answer for these consumers, more choice, rather than putting them in this bucket where they have to either get an overdraft or a payday loan, which is a terrible situation to be in, which is where a lot of these people find themselves because there aren't enough alternatives.
Okay. Main Street America has been hammered, and I'm Main Street America. I'm in the car business. Main Street's been hammered with new regulations during President Biden's first year in office, and one study estimated the true cost to be around $202 billion of regulations and 130 million man-hours to deal with these regulations, and it's a cost that businesses have to hire compliance people rather than salespeople to comply to these government mandates. So this means businesses are forced to hire more compliance officers who will be nothing but a drag on a company's bottom line because they generate nothing. I'm in a business that's totally commissioned. If you don't sell something, you don't eat. And to hire a compliance officer does nothing for me, does not help. So quickly, I know you've studied this topic extensively, and can you give us an overview, your view of regulatory what's regulatory optimization?
And that's a great point, which is this is one of the big reasons why this hits small banks so heavily, which is every time you enter a new business, a new line of revenue, you also have new compliance costs that go along with it. So if you're going to start selling insurance or something for small banks, this is very difficult.
If you have a way to put a compliance officer on commission, let me know.
Gentleman's time has expired. He yields back. The gentleman from New York, Mr. Torres, is now recognized for 5 minutes for his questions.
Thank you, Mr. Chair. It's become increasingly fashionable for banks and corporations to preach the gospel of equity and inclusion, but the banking industry should do some soul searching and ask itself, what are we to make of the racial inequity and exclusion brought on by overdraft fees? The imposition of overdraft fees at the expense of the poorest people of color in places like the South Bronx flatly contradicts every notion of equity and inclusion. Poverty is expensive in America, and the prohibitive expense of poverty in America can be measured in part by overdraft fees. The overdraft fee for a single transaction can be as high as $36, which is 5 times higher than the federal minimum wage. In 2019, overdraft and non-sufficient funds fees generated a historic high of more than $15 billion in revenue for the banking industry. According to the CFPB, overdraft and NSF fees make up 2/3 of revenues generated by fees. Overdraft fees are so common that 1 in 11 Americans pay more than $350 a year. And even more troubling, less than 8% of customers pay a staggering 80% of the overdraft fees. And is it fair to say, Ms. Hicks, that those customers are disproportionately lower income people of color? Ms. Hicks?
It is fair to say that the overdrafts are affecting people of color disproportionately. Again, in my testimony, we're looking at 80% of overdraft fees from 9% of those accounts. And going back to my colleague, Mr. Zaiwiki's point about overdraft fees not affecting low-income people, again, I state that people of color do not own the most wealth in this country. So if these accounts, if 80% of the overdraft fees are coming from 9% of the accounts, it must be coming disproportionately from people of color.
Well, according to the Pew Charitable Trust in 2016, 7 in 10 customers who repeatedly overdraft earn less than $50,000 a year, which is hardly high income in a place like Washington, D.C. or New York City. Nearly 25% of the repeat overdrafters pay fees equal to 1 week or more of wages. So let that sink in for a moment. There are 52 weeks in a year, and there are wage earners for whom a whole week of wages, several weeks of wages, are devoured by overdraft fees alone. Is it fair to say, Mr. Suero, that those wage earners are more likely to face barriers to accessing affordable and reliable credit?
Yes, so one of the things that we see is in the FDIC report from 2019, 3 answers that unbanked people gave were associated with costs when it came to barriers to gaining entry into the financial system. Another report from the Center for Responsible Lending found that 1 million people, roughly, were left out of the banking system as a result of overdraft fees specifically. And then we've seen a lot of research showing that the high cost of banking generally is an impediment for low-income people and Latinos to gain access to the financial system, yes.
So again, it's fair to say that when it comes to credit, there is a tale of two Americas. Those with higher incomes have access to affordable and reliable credit, and those with lower incomes in places like the South Bronx often have no choice but to pursue de facto credit in the form of an overdraft, which again carries a fee that is 5 times the federal minimum wage. Ms. Hicks, you spoke about the closing of accounts leading to the blacklisting of the lowest income Americans. Can you elaborate?
Yes, so overdraft fees, and when you were put in the cycle of overdraft fees, just like my husband and I were before I was able to find a job in California, it contributes to the cycle of when you're getting paid, most of your check is going to those overdraft fees. So with that, it does lead to people being unbanked, because if you overdraft multiple times, the bank is going to close the account. And because of these fees, people do not trust banks and decide to stay unbanked.
Mr. Zaiwiki, I suspect we're going to disagree on this question, but there are banks for which the majority of their revenues come from overdraft fees. If you're a bank for which the majority of your profitability, on which your very existence depends on overdraft fees, does that strike you as a healthy business model for a bank?
Yeah, I'm familiar. I've seen news reports on a couple of small banks in particular that do this. One that particularly concerns me is that there does seem to be some evidence that ever since the Military Lending Act went into effect, thereby restricting access to the military for a lot of other forms of credit, that they've ended up using a lot of overdraft.
Mr. Zaiwiki, I'm sorry I keep interrupting you, but everybody seems to end on you, and I have to stop you. So I apologize for that. There'll be an opportunity for the members to submit written questions to all of you, too, to follow up on this kind of thing. So the gentleman from Georgia, Mr. Loudermilk, is now recognized for 5 minutes for his questions.
Thank you, Mr. Chairman. This is a very intriguing subject, and as someone who is very familiar with overdraft fees, especially in my younger years in the military, I paid quite a few of those. And this is an interesting subject, but I do want to kind of quickly go back to some of the discussion we've had about who's paying the overdraft fees. I'll ask Mr. Greer or Ms. Hicks, whoever can answer this. I've heard the numbers. We're talking about who's paying the most fees. Are there instances that banks that are in minority communities, because some of the information I'm getting kind of sounds this way, are banks that are in minority communities charging a higher fee per overdraft than banks not in minority communities? Is that what we're saying? Is that why that minority communities are paying more in overdraft, because they're being charged more? Whoever can answer that question.
No, that's not what we're saying. Overdraft fees seems to be pretty standard across the board, except when you're looking at credit unions.
So the result is what you're saying is minority communities are doing more overdrafts than non-minority communities. Is that what we're getting at?
Minority communities are usually low-income communities, making $50,000 or less a year. And when you're taking care of a family and you're going to the grocery store and inadvertently overdrafting your account, yes, when there's inflation.
I mean, most of my life before I got into Congress, I made $50,000 a year or less. I never considered myself poor in that aspect, and I never overdraft after I learned a great lesson from that, and that lesson was went to the grocery store one time, had a buggy full of groceries that my family needed, and the grocery store wouldn't accept my check because I had unpaid overdraft fees, which is to Mr. Zwicky's point, that is a lot what people are using it for. But the issue I had was the expenditures I made at the beginning of the month, which while my colleagues in the military were bringing their lunch to work, I was eating out. I was going out with my family, so it was decisions to make. In fact, I started listening to Zig Ziglar. I don't know if you remember that. Zig Ziglar had lost a whole lot of weight. And he said, I finally decided that I was choosing to be overweight. And he said, because I never accidentally ate a double cheeseburger. Now, what that told me is I was making particular choices. And as one of my colleagues, Mr. Barr, said, there are people that are logically making those choices. For instance, the horse traders, they're paying a lot less in an overdraft fee than they would for a line of credit, right? So there is a choice function in there. I'm not saying that they're having to make this choice. Yes, there's some problems with this, and we do have to address it one way or the other because at the rate this administration is driving up inflation, I imagine this is going to get worse before it gets better. I do like some of the things that I heard Mr. Coonert say that they have done in their credit union, but I do have one question to ask there. You said this did cost you some revenue when you made your changes to the overdraft fee. How did you make up for that revenue? Did you just take that as a loss? Did you raise fees in other areas, or did you open up more lines of revenue coming in? How did you make up for that loss?
Well, we primarily made up for it over time by building more efficiency into the organization. When we benchmark our operating costs to other similar size institutions, we're often in the 90th percentile for operating expense efficiency per household. So that took some time and some focus, and but that's primarily how we did it, because we have to compete on price on all the other consumer products we offer.
Right.
We can't be out of line in market.
So basically, you cut some cost and you cut costs in other areas. Okay, that answers that question. And as I'm quickly running out of time, Mr. Zaiwiki, is it economically sound to expect a private business or private service or to provide a service it can't afford? I mean, what's going to happen if we force banks, and I know some banks that exclusively operate in minority communities, if we force those banks to make changes that they can't afford, they can't cut costs like the credit union has done, what is the result of that?
Well, the first thing that'll happen is they'll have to find fees somewhere else. The second thing is if you reduce the cost of overdrafts, people are going to probably overdraft more, which probably means your losses are going to go up as well.
And that does put people in a spiral. I've been in that spiral, but it was a spiral I knew I inevitably chose to be in because people who were in the same income bracket I was in were not having the same problem I was having. I'm not saying that's every case, but we do have to consider that when we're looking at making national changes. And I yield back the remaining time I no longer have, Mr.
The gentleman yields back the time he doesn't have. The gentlelady from Massachusetts, the vice chair of this subcommittee, Ms. Presley, is now recognized for 5 minutes for her questions.
Thank you, Chairman Perlmutter. Being poor in America is expensive. Millions of workers and families are living paycheck to paycheck, struggling to make ends meet due to unlivable wages, a lack of affordable health care, the absence of paid leave, and many other policies which are pushing families farther to the margins. And yet, these are the very same people, the very same families who at their most financially vulnerable moments are charged overdraft fees by banks. Ms. Hicks, some large banks have voluntarily reduced or eliminated overdraft fees, but many have not. According to the Brookings Institution, as of 2021, 6 banks relied on these fees for more than half of their net income, and 3 of those banks relied on them for 100% of their profits. Is it fair to say that this business model is based on making poverty a sustainably profitable enterprise?
Well, thank you, Representative Presley, for that question. And I keep going back to this point because I want to drive it in. And I wholeheartedly agree that this business model is based on making poverty a sustainably profitable enterprise. And as I stated in my testimony, nearly 80% of overdraft revenue comes from 9% of accounts with median account balances of $350 or less, making it very expensive to be poor. And just going back to the point that was made previously, it's not about choices, it's about access to resources.
Thank you, Ms. Hicks, and certainly no apologies here ever for being repetitive. As tired as people might be of hearing those sobering data points, imagine how exhausting it is to live those. Can we really trust banks that rely on overdraft fees for a majority of their income, of their net income, to voluntarily reform? Or do you agree that we need to ban overdraft and other junk fees for good?
I am extremely leery of financial institutions who in 2020 made billions of dollars in overdraft fees at one of the most vulnerable times in American history to voluntarily cease profiting from these fees. Using regulatory and legislative intervention is imperative to protect those living on the margins and from being preyed upon for financial institutions, and just to level the playing field for those who are being taken advantage of by this.
Thank you, Ms. Hicks. And so while I was calling for, to your point, building upon that, while myself and others were calling for overdraft fees to be abolished last year, big banks actually raked in billions of dollars of profits from those fees. So can you tell us how big banks capitalized off of people facing great and unprecedented economic hardship during this pandemic?
Well, Representative Presley, speaking of sobering data points, according to the American Prospect, JP Morgan Chase, for example, made $1.5 billion in revenue on overdraft alone in 2020. In the recent findings from the FDIC, during that same period, Bank of America made $1.1 billion in profits. Wells Fargo made $1.3 billion in profits. And in the final 3 months of 2020, when the pandemic was at its worst and deadliest, all 3 of those banks made $300 million just in overdraft fees alone. So while Americans suffered through the worst wave of the worst public health crisis in 100 years and unemployment was skyrocketed, the country's biggest banks were gouging poor Americans for billions of dollars in punitive fees.
Thank you, Ms. Hicks. I mean, it's clear that because it is profitable, it certainly is not incentivizing for them to do this on their own. So how can we reform such an abusive and predatory practice that punishes people simply for being poor? The short answer is that we don't. We have to abolish these practices once and for all. Thank you, and I yield.
Gentlelady yields back. The gentleman from Tennessee, Mr. Kustoff, is now recognized for 5 minutes for his questions.
Thank you, Mr. Chairman, and thank you for the witnesses for appearing today. Professor Zaiwiki, if I can, with you, I received an email, probably my colleagues do too, from Morning Consult. There was in February, they came out, their numbers showed in their survey that 89% of consumers find their bank's overdraft protection valuable. 74% of consumers who've paid an overdraft fee in the past year, frankly, were glad that their bank covered the overdraft, which runs contrary, obviously, to the tone of this hearing. But if I can, I'd like to drill down a little bit from Congressman Barr's questions to you. And as it relates to an overdraft fee for a debit card or an ATM transaction, the bank has to provide the consumer with the disclosure which lists the fee for the charge for the overdraft transaction. I'm correct in that, right? Is that right? Okay. And then the consumer has to opt in, if I'm correct, for overdraft coverage in order to be charged an overdraft fee, at least as it relates to the debit card or the ATM. Is that correct?
That's correct, yes.
And as a corollary, the consumer also can opt out at any time. Is that right?
That's correct, yes.
I'm just going to ask a rhetorical question. If a consumer can willingly opt into overdraft coverage or opt out, why are we trying to protect consumers or implore additional restrictions or take away the right for them to have overdraft protection on a product?
I don't know. They can opt in, they can opt out, and I think it's also significant, as I mentioned in my remarks, that people who overdraft frequently actually check their balances more often. They make more use of online banking, and they kind of constantly know what's going through their accounts, and they know they're taking a chance, basically, when they write when they make that payment.
Thank you, Professor. I think, as we all know, we're experiencing the highest inflation that we've experienced in 40 years due to the economic policies and the wild spending that the federal government's engaged in the last 12 months. The Federal Reserve reports right now that half of the country couldn't cover a $400 emergency expenditure. And obviously, few people have the resources to turn anywhere else to get help. So in the past, we've had banks offer short-term liquidity products. Obviously, regulation has effectively taken a number of banks out of this space, which means that ultimately consumers have fewer alternatives for emergency needs. So if I can, I came from a community bank board. Hypothetically, if you were running a community bank and overdraft protection were to completely go away, how would your community bank respond, and ultimately what would that mean for consumers?
I don't know. It's very limited. As you said, every time you try to add a new product, that adds more complexity, that more compliance costs. The other thing we know is that post-Dodd-Frank, community banks have already stepped back from products they used to add, such as mortgages, because of the regulatory cost and compliance associated with that. So I think it really puts community banks in a very difficult position.
Yeah. If you were a policymaker or you were in the financial services industry, what would you do to support or create innovative products to try to help consumers with their short-term needs? What else can we do?
As I mentioned, I think the answer here is more competition, more entry. As I said again, fintech, industrial loan companies, earned wage access, direct deposit, advance. All these things I think are viable options for consumers that solve this. And if I could just add one last thing, is the correlation here. At first, let me say I never said that doesn't affect low-income consumers. Obviously, this affects all consumers who overdraft, but especially low-income consumers because it's a fixed fee. But what drives this is credit score. And the Fed has shown that credit score is generally not correlated with income, and it's not correlated with demographic factors such as race. It's a credit score issue, not a race or income issue, once you control for credit score. In that sense, I'm not talking about sort of some things they're talking about, but I just wanted to make that very clear.
Thank you, Professor. Mr. Chairman, I yield back.
Gentleman yields back. I think we have three more members to ask questions. I'm going to go to Mr. Rose first, then Ms. Maloney, then Mr. Timmons. Gentleman from Tennessee is recognized for 5 minutes.
Thank you, Chairman Perlmutter and Ranking Member Lukemire, for holding this hearing, and thank you to our witnesses for being with us today. The CFPB, under Director Chopra, continues to assert that the financial services industry is not competitive and is using this as a premise to justify an extremely aggressive rulemaking agenda. Yesterday, CFPB Program Manager Joe Valenti published a blog post stating that, quote, overdraft fees are among the kinds of junk fees that far exceed what it costs the institution to provide the associated product or service and do not appear to be subject to competitive forces, close quote. Professor Zaiwiki, would you describe the market for overdraft products and other short-term credit as competitive, or do you agree with this blog post from the CFPB?
I think it's competitive. It could be more competitive. And we know, for example, in states that outlaw payday loans, what happens is NSF fees go up, bounce checks go up, overdraft fees go up, right? And so when you take away competition from banks, they make more money off of overdraft fees and NSF fees. And so I think the corollary is more competition for banks. There's already competition, but more competition, I think, would be the path I would pursue here.
The Biden administration seems to think that regulation, not market forces, drives competition. This was made especially clear in President Biden's 2021 executive order on promoting competition in the American economy. Professor Zaiwiki, do you think more regulation from the CFPB is the solution to increasing market competition?
No, and unfortunately, usually regulations reduce competition rather than increasing it, at least the way that it has been transpiring.
Professor, you previously served as the chair of the CFPB's Task Force on Consumer Financial Law under Director Kraninger. The task force identified recommendations for improving competition, including studying ways to ease changing accounts between financial institutions, avoiding the anti-competitive barriers to entry, and studying the cost of lending in key product markets. Could you describe some of the task force's work on these issues?
Thank you, yes, and we have a number of recommendations to go to this. So one, to mention something earlier, I really believe that faster payments is something that should really be something that we should push on, but also bank account portability, as you said, greater fintech. But I've talked a lot about credit scores, and I think one opportunity is to make greater use of alternative financial data, right? To look at other sources rather than traditional credit scores and determining who is a good risk and the like. And so I think there's a lot of room for innovation in this market to put more competitive pressure on banks to do better, to create bank account portability, open banking, and a lot of things that would cause them to be more responsive, I think, to consumer demand.
Could you drill down a little on the banking account portability question and what sorts of approaches you would recommend or like to see implemented there?
The details of that, I think, are still need to be worked out, but the model is obviously cell phone portability, which has been very popular, right? You can change your cell phone carrier while keeping your same number. Right now, it's very difficult to change bank accounts. It's really just a pain because you've got to deal with trailing checks and that sort of thing. And so I think trying to work through the regulation and the process of facilitate bank accounts, because right now people can change credit cards very easily, for example, which drives a lot of competition in the credit card market. But when it comes to bank accounts, they're very sticky, and banks make them more sticky. And rather than facilitating competition, if a bank wants new accounts, rather than trying to attract them, it seems like they just buy another bank, right? And so we consolidate the industry. We're getting more in the like. And so I think that would be something that would be worthy of study by the Fed and others of how to improve bank account, make it easier to switch bank accounts.
Thank you. I want to, in the last seconds I have, just relate an anecdote from one of my bankers back in my district who I was having dinner with a few weeks ago, and he related to me one of his customers, and this is kind of following on what Representative Barr said earlier. But he described a customer, an elderly lady, limited income, and she perpetually came up short at the end of the month. And so essentially once a month she overdrafted, and she came to the bank and she said, please, whatever you do, don't take away my overdraft capability. And I think it underscores that this oftentimes provides a needed outlet for many customers of banking. And thank you, Chairman. I yield back.
Gentleman yields back. I was mistaken. Mr. Timmons, you're going next. So I'm going to yield to the gentleman from South Carolina, and then we'll close with Ms. Maloney from New York. Gentleman's recognized for 5 minutes.
Thank you, Mr. Chairman. Professor Zaiwiki, since Dodd-Frank passed, how have community banks across the country generally fared?
They have not fared well. As we know, the banking industry has become more consolidated, and community banks have shrunk.
What about the GSIBs and regional banks?
The regional banks have tended to constrict also. The big banks have gotten bigger. The too big to fail banks have gotten even bigger.
Generally, who bears the brunt of proposals such as the Maloney overdraft bill? What types of institutions?
In the short run, small banks bear most of the brunt for the reasons we've talked about.
In federal requirements, federal regulations are largely more challenging to comply with when you are a smaller bank. Is that fair?
That's right. To hire another 150 lawyers at Citi is a rounding error. To hire one more compliance officer at some small bank could be the difference between profitability and not. So.
And they're already struggling with things like cybersecurity, where they're trying to invest appropriately, and that's a huge line on their balance sheet. So it's fair to say that if you're a small bank in this country post-Dodd-Frank, it's been challenging and they're barely getting by.
That's an understatement.
Okay, thank you, Professor. I'm confused at what exactly we think we are accomplishing with this hearing and the Maloney bill. It's obvious to me this is just another onerous mandate for smaller financial institutions like community banks and credit unions, especially given that consumers already have to opt in for overdraft protection and can opt out at any time. On top of this, a recent survey from Morning Consult shows that 89% of consumers value their bank's overdraft protection, and even 74% of individuals who had been subject to an overdraft fee over the last year were glad their bank had covered the payment. And why would they not be? What's the alternative to overdraft protection? Professor, if consumers no longer had access to overdraft protection through their financial institutions, what recourse would they have?
They would either be forced not to be able to purchase things that they need, or they would have to turn to some less attractive alternative, usually payday loans, because as we talked about, credit cards aren't available for these people. The other thing we know is that occasional overdrafters and frequent overdrafters are in a different category. You can often get a fee waiver, especially if you're an occasional overdrafter. And an important point that Michael Flores found is that low-income consumers are more likely to get fee waivers than people with higher levels of deposits. And so there's other things going on in people's relationships with banks if they're occasional overdrafters versus frequent overdrafters.
I remember long ago I had challenges with this. You know, first debit card didn't really, I wasn't very good with my money at a certain point in my time. My wife might say the entire life. But my question is this. I mean, how often do people get the benefit of overdraft protection and it changes their day or their week, and instead of the alternative, which is to be declined and be unable to do something? I mean, gas stations, grocery stores, there's often times where if you're not able to get the benefit of your overdraft protection, it could be very problematic.
And that's the fundamental problem here, Congressman Timmons, which is taking away people's options isn't going to resolve the problem, right? Which is taking away the supply of overdraft protection isn't going to take away the demand, that people still have a lot of bills they need to pay, a lot of necessities that they need to pay. And that's the fundamental problem here, or the fundamental difficulty, which is what happens to these people if you take it away? And based on what I can tell, the options are even less attractive than the ones they have now, especially given that they seem to be using it, heavy overdrafters, at least knowingly. They've opted in, they're monitoring their balances, and they understand basically what they're doing here, but they don't have better options available to them.
Sure, thank you. This hearing, this proposal, is just another example of my colleagues across the aisle thinking that they know what's best for the American people. They want to run our lives because they don't think that we're capable of making the right decisions. This proposal removes choice and options for consumers in the name of protection, but it's really just another way to impose the will of my colleagues across the aisle on the American people. Thank you, Mr. Chairman. I yield back.
Gentleman yields back. I was mistaken again. So Mr. Foster has arrived, and we'll let him ask his questions for 5 minutes. Then Ms. Maloney will close. Gentleman's recognized for 5 minutes.
Thank you, Mr. Chair. I find it interesting that many banks and credit unions are already making changes to overdraft policies. According to the CFPB, since September 2021, nearly half of the 20 banks that collect the most overdraft fees have announced that they will eliminate the fees altogether. I think this sort of behavior is likely to continue as we move to a high interest rate environment where you actually have alternate sources of income for banks, and they won't depend on, reordering things and so on to generate overdraft fees. So several of these have have already eliminated, as I mentioned, the overdraft-free programs in place. Chris Leonard, the CEO of Velocity, an overdraft and compliance management company, has asserted that overdraft fees should not be jettisoned completely, stating that many consumers actually like having the option, though I imagine very few like having their have the things reordered to maximize those fees. In reality, most of these fees are incurred because people are simply unaware that their account is too low, and well, they're about to incur a charge. Then, unfortunately, they get their cup of coffee or pay for parking, and they're handed a $30 or $40 fee to complete the $5 transaction. And considering that most accounts are rectified very quickly, that short-term financing option seems wildly unappealing from the consumer's financial standpoint. I am personally very glad to see that competition among the banks has driven this trend to modify or eliminate these fee arrangements. So my question, I guess, to all witnesses, someone has to be the first to eliminate overdraft fees in their checking products. Is this just a reaction to a wildly consumer popular idea? Or are there other factors influencing the change across the industry, such as, for example, moving to a higher interest rate environment?
Well, Mr. Congressman, one thing I want so we've been talking about protection and we've been talking about fees. Those two are different things. So people can opt into protection, get an expense covered through credit, charge the fee. There are banks that do that. Wells Fargo is one of them, for example. And then there are people that can opt out, and that they can then what they get is an insufficient fund fee, even though the transaction's been blocked. So I think there's been a lot of conversation about protections and fees, and I just want to say that those things are two different things in the financial sectors. So that's one. As far as industry-wide, again, I think we have to recognize that low-income, particularly people of color, are low wealth. And not having access to credit is one of the things that drives that wealth. Not having access to regular income that allows them to build assets allows them to build wealth. And to strip that money out of their accounts through things like fees has implications beyond, whether they're able to buy a cup of coffee or not.
And to your question, Congressman, about what has caused some banks to make these changes. In the middle of last year, around the middle of last year, Ally Bank and Chime, which are online banks, made announcements that they would eliminate fees or reduce overdraft fees. So that has put pressure on other banks to follow suit. And then in late last year, Director Chopra of the CFPB also made an announcement that the CFPB would focus more on junk fees, but on overdraft fees specifically. So I think the combination of the two things have also, in addition to consumers saying that they want overdraft protection and overdraft fees reduced, has led to these changes.
Yeah, Ms. Hicks, do you have any comments about so what's driving this and how much we can expect it to continue, without more intervention by the government?
I think my colleagues summed it up beautifully of what's driving it, and I just wanted to hone in on the point that fees and protection are different things. And we're not saying to end overdraft protection. We're just saying that these fees, as Representative Maloney points out in her bill, should be reasonable and proportional to what it costs the banks to actually take care of the overdraft.
Yeah, Mr. Coonert, can you talk about how your credit union was involved in this process?
Yeah, in my written testimony, I covered it in great detail, but we reformed our practices in 2010 in response to the Reg E update, and then last year reduced our fee to $5. Definitely there's change happening in the industry. Prior to 2020, you might have questioned, is there competition? There wasn't much evidence for it, but things are changing now. They've changed in the last year. How much of it is concern over regulatory scrutiny and how much is competition? I couldn't sort out right now. I think time will reveal that.
Mr. Coonert, I'm going to interrupt you this time, and the gentleman from Illinois' time has expired. I'll now recognize the gentlelady from New York for 5 minutes for her questions.
Chairman Perlmutter, and may I express how sad I am that you've decided to retire. Today's hearing shows your focus on protecting consumers, your focus on affordable housing. You'll be deeply missed. And thank you for having this hearing, as well as the ranking member. There was a report that came out from CFPB that showed that in 2019, consumers paid over $15 billion in overdraft fees. And granted, some people opted in, and I'm not trying to take away an opt-in. I think an opt-in should be there. If they want it, fine. But too often, people are caught in tricks and gimmicks and unfair, deceptive practices that force them really into overdraft fees, such as reordering the priority of your fees so that your rent check comes first. I know constituents, some of whom pay $200 in overdraft fees. They don't even know they've overdraft. They didn't know that they took their rent check and put it before their coffee or their sandwich, and it racks up. So my bill tries to cut down on these unfair and deceptive practices. I have here a report from the CFPB that I requested, and there are many, many people who have taken steps to change the overdraft fees, to eliminate them in some cases, or to lower them in some cases. But I've been studying this since 2009 when I put my bill in, and it's confusing to me because everybody's doing something different. Everybody's doing something different, and I applaud their efforts. But if I were a consumer, and I am a consumer, it's very confusing. So my question to Mr. Greer, Ms. Hicks, Mr. Coonert, and Mr. Suero is, do you think consumers would benefit by at least a minimum having some baseline level of protections for overdraft practices such as my bill? Let's start with you, Ms. Hicks, yes or no?
Absolutely.
Thank you. Mr. Coonert.
Yes, I do.
Okay, Mr. Suero.
Yes.
And okay, so now that's great. You all agree on that. Do you think those protections should include common sense limits on the number of overdrafts that are allowed per month? Improve transparency so people understand what's happening? Banning banks from reordering transactions to maximize the number of overdraft fees for people? Let's start with you, Mr. Greer.
Yes, I think it would.
And let's just go down. Ms. Hicks, Mr. Suero.
Yes.
Mr. Suero.
Yes, it depends on what that looks like, and we agree that some people definitely want overdraft protection, but yes, we agree with that.
So that's exactly what my bill does, but it allows people, if they want to have the overdraft protection, to opt in. That's one of the requirements of the bill, that people be notified that if you want this protection, you opt in. But too often, I hear from my constituents that they bought a loaf of bread, $35, a cup of coffee, $35, a newspaper, $35, and some at the end of the weekend, because they didn't know they overdraft, will have like $200 in fees. And I would say that that's unfair and deceptive and extremely hard on some of the most vulnerable in our society. Now, from your perspective, Ms. Hicks, do you think someone should be charged $35 for a $2 cup of coffee?
No, especially if they didn't know they overdraft.
Right. Mr. Suero?
I 100% agree.
Okay, and Mr. Greer and Mr. Coonert?
No.
Okay, I know
No.
you've gone down to a $5 cup of coffee, but and that's a movement in the right direction, but everybody's got something different here.
Actually, no, we have a de minimis so that no overdraft would be incurred for anything less than $10, and we don't permit overdrafts from debit card use.
But as you see, everybody has a different proposal. I would like to suggest, since the CFPB was referenced several times during this committee, that we invite the chairman of the CFPB to come in for some clarifications on this. And I do have a bill that I've had in for a number of years, the Overdraft Protection Act, which has common sense. Some of the panelists today have endorsed it. It has common sense practices that protect the consumer. And I, for one, would like to see that $15 billion kept in the pockets of some of our most needy residents, not going to unfair, deceptive, manipulative overdraft fees. My time has expired.
The gentlelady's time has expired. Mr. Chopra is to testify in front of the full committee next month, so we'll have an opportunity to discuss this with him then. Do you want to introduce that chart into the record?
I would like to introduce it into the record, and I'm going to have it up on my website, and
Without
I think
objection.
we should put it up on the website of the committee.
It's in the...
And it's very confusing, but I applaud Wells Fargo, J.P. Morgan Chase, Bank of America, TD Bank, Citibank.
Okay, it's in the record.
There are about 13 banks. 13 banks have come out and curbed them in some way or another, but each one has done it differently. No one has done it the same way.
We got it. The lady's time has expired. We will introduce your chart into the record. I want to thank the witnesses, and I want to thank all of you. You know, the discussion about fees versus protection, I think, is very important, and make that distinction. And I appreciate everybody's testimony here today. Without objection, all members will have 5 legislative days within which to submit additional written, written questions for the witnesses to the chair, which will be forwarded to the witnesses for their response. I ask our witnesses to please respond as promptly as you're able. And without objection, all members will have 5 legislative days within which to submit extraneous materials like that chart to the chair for inclusion in the record. And finally, I remind members that written questions and materials for the record should be submitted to email address provided to your offices. Thank you all very much for your time, your testimony, your patience with us. With that, this hearing is adjourned.